All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications. Nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research. Welcome to Tricks of the Trade. I'm Rick Adams. We're going to look at trade setups in two stocks today, beginning with Rocket Lab Corporation. Trades under the symbol RKLB on the NASDAQ. The aerospace and defense company reported a second quarter loss of 13 cents per share compared to a loss of 8 cents per share in the same period a year ago. Revenue came in at $144.5 million, an increase of 36% from the year ago quarter. As of market close on August 19th, the stock is up nearly 61% this year at $40.92 per share. That's up 178% from the April low, but down 23% from its all-time high that was set in July. 12 months ago, the stock traded as low as $5.74, so the current share price is up nearly 613% from that low. On a technical basis, the share price is above its 50-day moving average by 3% and above its 200-day moving average by nearly 52%. And on the daily chart, we see the 20-day moving average has curled and begun trending downward, but the 50 and 200-day moving averages continue to trend higher. And all three trend lines remain stacked, which is indicative of a strong bullish trend. That is where the shorter-term average is above the intermediate average, and both are above the longer-term average. The question, though, is whether or not the share price can hold support at the 50-day moving average despite an 8% pullback below the 20-day moving average. We also have a descending channel that began on July 17th as the stock posted lower highs and lower lows. However, we also have an ascending trend line that began on June 13th, and so far that ascending trend line remains intact. I looked at a couple of trade setups on this one. The first is a collar strategy where I would have limited upside potential, but at the same time, I would also limit my losses on the downside. And that's achieved by writing an out-of-the-money covered call and then buying a put option at a lower strike. I looked at buying shares of the stock at $40.92 rather, and then in the October monthly expiration cycle, I looked at selling a 41 strike call and using the collected premium to buy a 35 strike put. The two options result in a net credit of $2.74, which right up front would give me a 6.7% yield on the share price and lower my cost basis on the stock to $38.18 per share. That would be my break even on the trade, so anywhere below that level is where losses would be incurred. Max profit is $282 to the upside above the 41 call strike, and the max loss on the trade is $318 to the downside, or below the break-even of $38.18. That gives the trade a risk-reward of roughly 89 cents of potential profit for every $1 of risk. Now, alternatively, if I don't want to buy shares of the stock, I could sell a vertical put spread at a strike that's near that break-even of $38.18. In the same October expiration cycle, I looked at selling a 38 strike put and then buying a 35 strike put for a net credit of $1.04 per share. That would give me a break even of $36.96 per share, which is about 10% below the current share price, and also where losses would be incurred if the share price were to fall below that level. Max profit is $104 to the upside if the share price remains above both strikes, and the max loss is $196 to the downside if the share price falls below the 35 strike. That gives the position a risk reward of roughly 53 cents of potential profit for every $1 of risk. Now, one important note here about put options is that sellers assume the risk of owning shares of the underlying stock at the strike price of the put option. So on this trade, by selling a put at the 38 strike, I would assume the risk of owning shares of the stock at $38 per share if the stock price were to fall below that 38 strike. Even if the stock price were to fall to, say, $5 per share, I would be obligated to pay $38 to buy the stock. Although in that extreme example, I would also have the 35 strike put as protection, so my losses would stop at $35 per share. Zoom Communications reported second quarter earnings of $1.53 per share. That's an increase from $1.39 per share in the year-ago quarter. Revenue came in at $1.22 billion, up 5% from the same period a year ago. The positive earnings release sent shares higher by more than 5% in after-hours trading and up more than 12% during the regular trading session. Zoom trades under the symbol ZM on the NASDAQ, and the stock doesn't really do much in terms of daily volume, a little over 1.3 million shares on average. Implied volatility is in the top 1/10 of its range at 45%, giving the stock an implied volatility rank of 60. But because it's a thinly traded stock with light volume, the option markets tend to be pretty wide between the bid and the ask. Despite the wide markets, though, there are still some trading opportunities, and we'll take a look at those in a moment. Now, Zoom was a rock star during COVID, surging all the way up to $588 per share in October of 2020, but now not so much. As of market close on August 21st, the stock is trading at $73.17 per share, down more than 87% from those October 2020 levels. This year, the shares are up more than 13% from the April low, but still down more than 10% year to date. And on a rolling 12-month basis, the share price is in the lower half of its trading range. On a technical basis, the share price is above its 20-day moving average by less than 1%, and has been below its 50 and 200-day moving averages since July 9th. The moving averages are currently in a death cross where the shorter-term moving averages are below the longer-term moving averages, and we can see that here with the blue 20-day moving average trending below the yellow 50-day moving average, and the yellow 50-day average trending below the pink 200-day moving average. There was a strong upward trend line that began on April 7th, but that bull run was short-lived as the upward trend line was broken on May 20th. And although the share price has been stuck in a descending channel, we see by the dashed line that an upward trend has developed over the previous 7 trading days, with the stock posting higher highs. As for the trade setup, I went out to the October monthly cycle with 57 days until expiration and looked at selling a vertical put spread, selling the 70 strike put and buying the 65 strike put for a net credit of $1.04 per share. That $1.04 credit represents roughly 20% of the $5 spread between the two strikes and takes the break-even down to $68.96 per share, which is more than 5% below the current share price, and below that point is where losses are incurred on the trade. Max profit is $104 to the upside above both strikes, and the max loss is $396 to the downside below the 65 strike. That gives this trade a risk-reward of roughly 26 cents a potential profit for every $1 of risk. Alternatively, for an increased profit potential, I could put on a collar strategy where I buy shares of the stock at $73.17, and in the same October monthly expiration cycle, sell a 75 strike call to lower my cost basis, and then buy a 67.5 strike put as downside protection. The two options would result in a net credit of $1.67 per share, giving me a 2.3% yield on the share price, and reduce my cost basis on the stock to $71.50 per share. Max profit on this trade is $350 to the upside above the 75 strike call, and the max loss is $400 to the downside below the 67.5 strike put. That gives this trade a risk reward of roughly 88 cents of potential profit for every $1 of risk. Now, if on October 17th, when these options expire, the share price is between the 75 and 67.5 strikes, then the entire $1.67 per share credit would be kept as profit, and I would continue to hold shares of the stock. On the other hand, if the share price were to fall significantly, the 67.5 strike put would limit my loss to $400. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.